We've spent the last few weeks sifting through just stacks of market intelligence, really trying to get a handle on December 2025. And the big picture we're seeing is just this frantic global scramble.
It really is.
So our mission right now is to give you the shortcut to really understand the power shifts in tech and the capital movements that are defining this moment.
Right.
Let's just start where the action is hottest. I mean, the battle for technological dominance, specifically in AI.
And that battle, it's no longer purely about technological breakthroughs. It's really about building a fortress around the market share you already have.
A fortress.
Exactly. We're seeing this with OpenAI. They're shifting their focus so intensely toward the bottom line. Their main defensive strategy right now is all about improving paid product margins.
So it's about making money predictably.
It has to be. They need rock solid, predictable financials to, cement that early lead they have against all these rivals coming up behind them.
And securing that lead is just wildly expensive. The financial gymnastics here they're kind of extraordinary.
Well, absolutely.
I mean, we are watching SoftBank aggressively race to lock in $22.5 billion in funding for OpenAI before the year is out.
And here's where it gets really interesting.
It's the urgency, right? It's so high that SoftBank is leveraging asset sales and borrowing against its own crown jewel, its stake in ARM, just to hit that cash target.
This isn't just a funding round.
No, it's a structural reorganization.
Yeah.
You have Masayoshi Son being willing to cannibalize his core non-AI assets just to keep this dominance play alive.
That level of commitment, it signals incredible conviction, but it also shows you the intense pressure they must be under.
For sure.
And meanwhile, their rivals are making these very calculated personnel moves. I mean, look at Google's promotion of Josh Woodward.
That felt significant.
Very. He's now tasked with coordinating their AI research and commercialization. It's a clear signal that Google is doubling down, treating this like a war room priority. They're not letting up.
But the narrative isn't just. It's not monolithic.
Right.
We heard something fascinating from Salesforce, kind of a counter trend.
Oh, right, the trust issue.
Exactly. They're seeing total reliance on large language models actually start to decline, and they're linking it directly to these increasing corporate trust concerns.
So the initial hype is wearing off a bit.
It seems like it.
Yeah.
The unbounded hype is giving way to, real-world scrutiny about data privacy, bias, reliability, all the hard questions.
That's a crucial distinction. It suggests companies are moving past the shiny object syndrome and asking, how do we actually integrate this stuff responsibly?
But even with those trust hurdles, practical application is just accelerating where the use case is immediate.
Like ride sharing.
Case in point.
Oh.
Uber and Lyft are now trialing Baidu's Apollo Go robotaxis in London's. They're integrating that service right into their apps.
Which is a huge milestone. This is moving autonomous tech from, a test track into the reality of a mainstream platform.
Okay, so that shift in capital isn't just in tech. Let's look at the major M&A moves that really dominated the end of the year, starting with pharma, which has been sizzling hot.
Yes, the reports around Abivax. The stock jumped, roughly 10%?
It did, all following reports that Eli Lilly was actively exploring a takeover. They even met with French government officials, which confirms how serious these talks were.
Lilly is clearly hunting for assets that complement its blockbuster pipeline. And the fact that they're willing to engage foreign governments just shows how strategic and high level these acquisitions have become.
And we're also watching these huge private equity deals reshape, of all things, the back office of finance.
Right, the Clearwater Analytics deal.
Yeah.
You have Permira, Warburg Pincus, and Temasek, three massive global players partnering up to acquire them for $8.4 billion.
$8.4 billion for back office data solutions and asset management infrastructure.
It speaks volumes, doesn't it? It's about the persistent demand for tools that handle regulatory compliance, accurate financial reporting.
They're investing in the mission-critical plumbing of finance.
Absolutely. And shifting to energy, the consolidation wave is just relentless. Harbor Energy offered $3.2 billion for Elavag exploration.
All to boost their Gulf of Mexico output.
Exactly. This isn't just consolidation for its own sake. It's a strategic move to pay premiums for reliable, proven, high-volume output in, established, less politically volatile basins like the Gulf.
That focus on shoring up core portfolios is just amplified by the speculation around BP.
Oh, for sure. The leadership shakeup there immediately reopened all that long-standing talk of a potential mega deal with Shell.
The majors are clearly reevaluating their optimal size and scope in this energy transition era. They're looking for stability through sheer scale.
And resilience is paramount, right, across all sectors. Which leads us to manufacturing capacity. Samsung Biologics bought GSK's huge drug facility in the US for $280 million.
So why do that?
It's a supply chain decision. Plain and simple. It's about rapidly expanding their U.S. capacity, reducing reliance on overseas production, and building that domestic resilience in drug manufacturing.
Now, let's connect all this high-stakes corporate maneuvering back to, the person on the street. If we look at consumer markets, we're seeing businesses have these vastly different experiences.
Like Kukri?
Right. Following a serious share price slump, they appointed Marcus Strobel, a veteran from P&G, as executive chair and interim CEO. This just screams, we need a major operational overhaul, and we need it right now.
That's the story of companies trying to fight a decline. The contrast is Jim Beam.
They're adjusting.
Exactly. They're actually shuttering a Kentucky distillery in 2026. This isn't necessarily a failure. It's a planned adjustment to meet what they see as significantly declining consumer demand in specific segments.
So the very tangible signal of where consumer confidence, or at least preference, is pulling back.
And it's impacting real-world infrastructure.
So if consumer giants are adjusting their footprint, what does that mean for the big money? Let's pivot to global financial signals and the 2026 investment outlook.
Okay. Looking back at 2025, the winners were, well, they were crystal clear. Chips, gold, and surprisingly, firearms and related defense stocks. They all outperformed.
And the losers.
Advertising firms and private equity funds. They lagged significantly.
What's fascinating to me here is the shift in which commodities are outperforming.
Yes. The surge in specific industrial metals, right? It's driven by the dual demands of AI infrastructure, massive data centers, and the energy transition.
So it's pushing market interest way beyond just traditional safe havens like gold.
These are the metals you need to literally power the future economy, and their performance reflects that foundational demand.
But the sheer scale of this AI rally has created the elephant in the room. Bubble concerns.
Huge concerns.
Analysts are predicting that these fears are going to drive sharp swings and serious U.S. stock market volatility all through 2026. The market is it's priced for perfection.
Any minor hiccup in earnings or demand is going to create a powerful whiplash effect.
And that anxiety is compounded by a classic contrarian worry we're seeing.
The fact that everyone's on the same side of the boat.
Exactly. Strategists across Wall Street are almost uniformly bullish on the 2026 S&P 500 outlook. And when everyone agrees, that often serves as a classic contrarian signal.
It suggests the market is dangerously complacent, like everyone showed up to the party in the same expensive outfit.
And the risk is migrating in subtle but powerful ways. The AI boom is starting to affect fixed income.
It's turning what used to be one of the safest parts of the corporate bond market into something riskier.
Why is that?
Mainly because the debt associated with these highly concentrated, high-growth tech plays, it now carries an outsized systemic risk if that rally falters. The whole definition of safe debt is fundamentally changing.
So Wise Capital is getting ready for this shift.
Absolutely. We saw macro hedge funds achieve their biggest gains since 2008, and that was fueled by profiting off market turmoil in FX, gold, bonds.
This wasn't luck.
No, this was a strategy capitalizing on volatility that was driven by policy divergence.
And look at Apollo Global, a massive asset manager. They are actively trimming risk, cutting leverage, and consciously building up large cash reserves.
They're preparing their war chest. They want to seize opportunities when the market turbulence, which they clearly see coming, inevitably hits.
And that preparation is directly influenced by what central banks are doing or not doing.
Right. In the U.S., the picture is sort of stable, but it's awaiting definition. Fed Governor Hammack signaled they plan to hold rates steady for months.
This period buys time, not just for the economy, but for the industry to watch closely as a final decision nears on who succeeds Chair Jerome Powell.
And that leadership succession is a massive unknown for monetary policy globally.